Hi, my name is Will Morris. I'm managing partner of the Blue Aura Group, and I wanted to run over how our asset allocation fund is different. When I'm talking to people and they say, what is asset allocation? What does that even really mean? And then you explain it to them, and they say, well, how is that even different than, um, any other fund? And so I want to show you, for example, on the board here, we've got, we'll kind of give you a visual, I guess. I'm kind of a visual person. So just give you an example right off the bat. Your typical fund, let's say your typical fund or investment co, whatever. Investco they are the sponsors and the managers of their investments, right? And so they're going to find property one, they're going to find property two, and maybe roll in a property three, right? And so when you make an investment into this investment company, you are investing into one sponsor. So they have one sponsor. I hope you can see that. Typically, let's say 2 to 3 deals. And you're basically locked up in those for a period of really 7 to 10 years. Okay? And so your money, when you invest in these type of companies, it will go into this investment co, and then they're going to take your money and they're going to invest it into 1, 2, maybe 3 properties, somewhere around there. They usually don't get too many properties in there, but let's say 2 to 3 deals, and then your money's tied up. Your money's tied up for 7 to 10 years on average. 10 years is kind of the standard industry norm on how long these funds are open, and your money sits there. And you may get some cash flow, you may get some upside as they perform, but really you're back into the sponsors, right? You're investing into this one fund that is really controlled and operated by one sponsor, and that one sponsor, your investment is directly correlated to their ability to be able to carry out that business plan, right? And so nothing wrong with this. There's benefits to this. A lot of times structured as a pass through, just like ours, where you get the appreciation, the depreciation. So a lot of benefits, right? However, what I want to show is the difference between that model compared to the BAA fund. So let's do the same thing. We got BAA, which is the Blue Aura Asset Allocation Fund. And so it's pretty much the same concept, but the difference is instead of going directly into properties, we go out and we find, I don't know how to do this. So we're going to find a sponsor. Got my little stick person here. Yay. We're going to find sponsor number 1. We're going to find sponsor number 2. Because we're investing in funds, right? We're investing into funds. And, I'm not going to draw all of them, but let's say we got 3. We go into 3 different funds, 3 different sponsors, and each one of them has 3 deals. So 1, 2, 3. Oh, did that wrong. Carried away my drawing here. So let's say 1, 2, 3. Right? I keep wanting to do it. 1, 2, 3. Okay. So now you've technically got 9 different deals. Your money, your capital is going into the funds, the sponsors, and then they're going into 9 different deals, let's say, in this example. So now your money's diversified, right? It's diversified not only across properties. So let's say this one over here is multifamily, right? Let's say this one over here is mobile home parks, and let's say this one over here is industrial. Okay? And so now your capital, your money, is diversified between multifamily, mobile home parks, and industrial. And why do I say those 3 specifically? Multifamily has great income, appreciation, depreciation value. Mobile home parks has really good income. That you can't really do a cost seg study on it though, so the depreciation not so much. And industrial is a decent little equal medium. And so now you've got a nice portfolio that you're going into, that your capital is flowing into, and all these are generating revenue. So all these are passing through revenue, which are passing up to you on every one of them. Now, one of the questions I get about this, they said, well, wait a minute, if you're investing into a fund, if you're a fund and you're investing into another fund, is that not, double fees? Are there double fees? And the answer is yes. Simple answer is yes, there's double fees here. But part of our due diligence is that we negotiate a lower fees. We negotiate higher income, higher splits for our investors, because we're typically making a larger, sizable, larger investment compared to their fund's minimum. And then also for us, we have actually lowered, I think we're at 1.5%, which is management fee, asset management fee, which is, low compared to the industry norms. And we're also giving away 80% of the upside. And so our investors get 80%. We're keeping 20. Whereas, typical fund, 2 and 20 model, we cut that down a little bit. And we also are giving pref. So you guys are getting, our investors get prefs on this, the 6% pref. You're getting the first 6%. And then, 80% of everything above that. To me right now, as long as you can do this effectively and you can, really vet these sponsors, which what we do is we actually go through a qualifying process, and then we actually go spend time with them. We actually spend 2, 3, 4 days with them on site, walking their properties, walking their, previous acquisitions, current acquisitions, doing our due diligence on past performance. And ultimately, we really even get involved in their personal life, because the last thing I want to do is invest money with somebody that has a good business track record, but come to find out they're on the edge of, addiction or something like that could come back and harm our investors' return. And so we're really getting personal with them. We're going to make sure that those are good, lifelong type of investments. And, then ultimately, as long as you do a good job with that, making sure we also make sure that we're on the GP. We demand a portion of the GP, the general partnership of each one of these funds. And so therefore that allows us to, have a say, not going to say a say so, but we do have a vision into what they're acquiring and how it's looking and stuff like that as well, and have a little bit of a vision on say so in the capital as well. So this is kind of the difference. This gives you diversification, which is obviously where you need to be right now. You need to be diversified. It gives you income. I don't know if this will work or not, but the big one here is the income. You've got right now, one of the best things you can do is hedge against inflation, which income is what can provide that, right? Cash flowing, income producing assets is amazing. And so that's what you need right now. And so that's kind of the difference between a normal fund or a standard fund and our asset allocation fund, the BAA fund. If you'd like to learn more, this is for accredited investors only. Minimum $100,000 investment. If you would like, it's a $100 million offering, so we got plenty of room to grow. This is something if you're interested in, let me know, and I will be sure to get out the OM and the prospectus, let you take a look at it, and go from there. So again, I appreciate your time. Hopefully you found this educational, beneficial. If you have any questions, reach out to me, will@blueauragroup.com. I am happy to help. Talk soon. See ya.